Hey guys, in this video, I wanted to talk about the closing costs. What kind of closing costs should you expect when purchasing a home? And in this video, I want to talk about two different scenarios. The first one will be a family buying a house in a 200 price range, and then the second scenario will be a family buying a house in a 600 price range. And what are the closing costs? Why are they different? And what really goes into it? So this video will help you understand the closing costs so that you know what to expect going in. And when you talk to a loan officer, you'll know what they're talking about. So if this is something you're interested in watching and learning about, don't go anywhere. Watch it till the end. I'll also share a tip on how to save on your closing costs. Let's do this. When we talk about closing costs, you have certain fees, certain closing costs that are firm, standard, like lender fees, title, appraisal, and then you have some fees that are not always there, such as escrows and points, buying down the interest rate. So in the first scenario, let's talk about a family buying their first home. They're purchasing a home in a 200 price range. They're putting 3% down, and because you put 3% down, you also are required to have an escrow account. And what does that mean? Okay, so when you purchase a house, you have your down payment. So in this case, 3%, that would be your down payment. The closing costs, if we look at the lender fees, like the processing and underwriting, they can vary anywhere from 1,000 to 2,000 even. With us, with Cherry Creek, we charge only 1,200, so we're on the lower end because we're very competitive. So you have your lender fees, you have your appraisal, title fees, registration, attorney fees, and so on. So the standard fees, if we break apart the closing costs, I'd like to break them apart into three different sections. Okay, so the standard fees, the set fees, you can expect in Texas, and this is in a scenario where the title policy is paid by the sellers and the survey is also provided by the sellers. So if the seller has the survey and if the seller pays your title policy, you can expect about $3,000 just in firm standard set closing costs. Okay, the second thing that goes into it is an option to buy down your interest rate. So if you decide to buy down your interest rate, you can pay an extra point, which is 1% of the loan amount, to buy down the interest rate, which is basically prepaying and lowering your interest rate for the life of the loan, but there's an extra cost for it. Now, do you have to do that? No, but in most cases, a lot of people will buy down your interest rate 1 point. So in the case, if it's a 200 price range home, you have $3,000 in closing costs. Points would be an additional, let's say 1 point from that would be an additional 1,900 bucks roughly. And then you have your escrows. When we talk about your prepaids, your escrows, we're talking about homeowners insurance and taxes. So those are the only two things that go into your escrows. Okay, so the homeowners insurance needs to be prepaid 1 year in advance. So you have to have a whole year prepaid in advance. So that's 12 months of your homeowners insurance. And then you also have to have an additional 3 months in reserves for your homeowners insurance and 3 months of reserves for your taxes. And this is because if you were to close, let's say this month, all mortgage payments are due on the first of the following month. So you do skip 1 month before your first mortgage payment kicks in after closing. And the law requires that you always have 2 months cushion for both homeowners insurance and 2 months cushion for taxes. So we do 3 months because you skip 1 month. We want to make sure you don't fall short later on your escrows. So if you think about it, a 200 sales price with your down payment, your closing cost of 3,000, 1,900 in points, and about 2,700 in escrows, that would bring a closing cost to about 7,600. Okay, so 7,600 on a 200,000 purchase home. Those would be your standard closing costs. Now, the second scenario I wanted to talk about is a family that's sold their house and they're purchasing their second home in a 600 price range. They have better credit scores, 780, 800 credit scores. They're putting 20% down. And this borrower told me that I want to get the loan with the lowest closing cost possible. So I'm not buying down any points because the rates are still crazy low. If you think about it, rates have been low in the last 10 years. So this borrower, because they have better credit scores, they're getting a better rate anyway. They decided not to buy down the rate. So they're getting the rate at par with no points. And they also decided to waive escrows. And since you're doing 20% down, you have an option to waive escrows. That means that the taxes and insurance would not be included in your monthly payments going forward. So when the taxes are due on December 1st, they have to pay them separately, out of pocket. And then the homeowners insurance, they do have to pay that outside of the closing numbers, right? So they do know they have to prepay and have 1 year homeowners insurance bought up front, but they pay for that separately. It's not part of the closing costs. So in this case, if they don't have any points, they go with the rate at par, and they waive escrows. And again, same situation. The seller is paying the title policy. The seller is providing the survey. In this case, their closing costs are just $3,000. So in the previous situation, a 200,000 purchase, their closing costs were 7,600 roughly, and on a 600 purchase, it's only 3K. So I just wanted to bring this to your attention, is that this is what goes into your closing costs. So it might be a little bit different for you based on your situation, how much money you're putting down, what kind of credit scores you have. Are you interested in buying down the rate or not? If you have to include the escrows or not. So in the case where it's a 600,000 purchase, a much higher price range, their closing costs are much, much lower. And I wanted to bring this to your attention so you can understand a little bit more on how this works. Now, does everybody have an option? Now, does everybody put 20% down when they buy a house? No, of course not. So if you do put a 3%, 5%, or 10% down, you have to have the escrow account. So you have to add the taxes and the insurance, and that would, of course, increase your closing costs, right? But the cheapest way you can get, and these two options are on conventional loans, 30-year conventional loans. Conventionals are really the best and the cheapest loan product and most common one as well. So in these two cases, on a 200,000 purchase, the closing costs are more than double than on a 600,000 purchase. Wanted to make this video for you because not everybody knows that. And but if you're trying to get a loan and you're putting more than 20% down, you don't have to buy down the interest rate. You don't have to have escrows. You can waive them. Some people will say, hey, I'll take that money instead of putting it aside in an escrow account, and I'll invest it in something else. I'll go to my financial advisor and put that money in a vehicle that will generate money, make money, interest on it, right? So depending on your situation, make sure you talk to your loan officer, go over different situations and see what you can do. So if you're starting and you don't know how much exactly do you need, I think a safe bet would be about 3 to 4% in closing costs. So if you're looking to buy a house and you can save up about 6 to 7% of the sales price, whatever it may be, 200, 300, half a million, if you can save up about 6 to 7% of the sales price in savings, that would cover your down payment and closing costs, and it will give you some options to make sure you have enough money for the escrows, for points, and you should be good. You should be good going forward. So, and the bonus tip for you to save on your closing costs, sometimes, not for everybody, because it just depends on how long you plan on staying in the house. Sometimes clients will bump up their interest rate. That's one way of lowering your closing costs. You can go, because lenders, we don't really keep any money, because you have your rate at par, that doesn't cost anything, right? If you pay down, if you use points to buy down your interest rate, that's a cost to the borrower, but you can go up. So let's say you're getting a specific rate, you can bump it up a little bit, maybe 1/8, which is 0.125, or maybe a quarter, bump up your rate a little bit. And then whatever is over, it's overage. That's basically something that the lender can give you back as lender credit. So you can easily bump up your rate by maybe 1/8 or a quarter, and you can get a couple grand towards your closing costs. Is that good for everybody? No, depends on your situation, right? If you plan on staying in a house forever, if it's your home for forever home, then keep the lower interest rate because it'll save you more money. But if you're going to live there maybe for a few years or you're not sure, it's just another option, something worth looking into. Check with your loan officer, see how much money they can give you back if you were to bump up their interest rate a little bit. So I hope you find this information helpful. Make sure you check out some of my other videos. If you have any questions or comment, leave them in the comment section. And thank you again for watching, and I'll see you in the next video.